Well, from capital growth to capital preservation, Australia's budget shakeup could trigger one of the biggest investor reallocations in years. So let's get an update. Tom Cranfield from Zagga. All right, welcome, Tom. Nice to see you.
Thank you very much.
Can you flesh that out for us a little bit? Because that's what I was wondering is, are we seeing changes in asset allocation in your view already?
Well, we're seeing changes which are being made reactive to legislation that's been proposed. So currently we still have to pass through the Senate, and we're well aware of those changes having to actually take a hold, but everyone is being proactive with understanding how their portfolios are positioned and what they need to do in order to maximise their opportunities going forward. So we do believe that there will be a shift in investment attitude. We think that there will be a change in how portfolios are constructed. We're not the investment advisor, but as the manager of investment capital, particularly with the private credit real estate flavour, we are thinking that there could be structural change as a result of what has been proposed by the federal budget. The changes that we're thinking that could come are less investment in secondary property and more investment into managed investment schemes and funds, because you can get income growth without the capital gains issue being attached to it.
Yep. So just to pause there for a moment. So if the government has made investing in property directly less attractive, that there still will be that demand for the diversification within portfolios. It's just they'll look for a different way to do it.
Absolutely. People are looking to get exposure to an underlying asset class that is well understood. And if you look at the value of residential property in Australia, according to Cotality's number, you're looking at over $12 trillion of value. So we know that 55% of Australian wealth is held in real estate. So the exposure to the underlying asset class, but the means by which they gain the exposure to something which is low in volatility, well understood, and with an ability to give them a return on their investment in a structure that their wealth advisors are giving them an opportunity to make that consistent low volatility return opportunity. And now you can do it in a way where maybe you don't have owners corporations, council rates, water rates, where the negative gearing might produce a low yield. You can get a consistent, stable, high single-digit style return on what we believe to be relatively well-adjusted, low-risk, risk-adjusted returns.
Mm-hmm. But then for the capital allocators like yourselves, does the quality of the deals, if you call it that, on offer change significantly in light of some of the perhaps even unintended consequences of this proposed legislation?
Yeah, I mean, again, we're looking at what's been proposed under the budget. Everything's obviously got to take a hold, but if you look at what it has done on the developer side of the equation, you've seen that it has incentivised new development, that they're looking to bring supply to the market, and that the tax benefits will only exist on new acquisitions of stock. So if you did want negative gearing, it's through acquiring new property. As a private credit or investment manager, what we invest our capital into is only new builds. So we're not in the secondaries market. So where investors may no longer want to buy an apartment in a 3-story walk-up, but they want a brand new apartment in a 12-story building, we actually see a dual track benefit for both our ability to find opportunity, to maintain the risk settings on that opportunity, if not even improve the risk settings of the counterparties with better developers, because developers are being signalled to by the government that they want supply, they want new product. And that's why we invest more into residential real estate, multi-level residential, than any other asset class. We see less volatility, bigger supply-demand dynamics in play that are favourable for investment tailwinds, and the ability to give our investors a return consistently without changing the risk settings for them.
Tom, forgive my ignorance, but is there a big offshore demand for Australian real estate private credit?
Absolutely. You've seen many of the managers, including ourselves, pivot and move towards offshore capital. You can see that they now have higher barriers to entry to own hard assets. They want, again, risk-adjusted returns that are stable and consistent, and you've got an expanded marketplace. I mean, the Australian private credit marketplace is now over $200 billion and projected to be bigger than the Australian bond market by 2029. So there's a scalable opportunity for offshore capital at returns that it considers favourable, and you've got structural change in the marketplace, but now you've got structural change for investment, and you've got an opportunity for developers to continue bringing product to the market. So we truly believe that offshore capital, particularly in the Asian region, will continue to come down into Australia. We've set up a Singaporean structure which we've run for more than 4 years with a fund management group. We've been active in Japan, and we're already looking at Korea. So we believe that that region will continue to channel down, and it will come in multiple ways: student accommodation, build to rent, multi-level residential. All those asset classes we think are primed by the opportunity